If you have ever tried learning about stocks and shares, but it felt like you were learning another language, maybe Spanish or French, you are not alone. Today, I'm simplifying the most common stocks and shares terminologies, from technical indicators, abbreviations, and all the jargons in just 5 minutes, hopefully. So it is my hope that by the end of this video, it will sound like you know what is going on if you are new to stocks and shares. Let's dive in. Section 1, I'm simply going to be explaining market direction terminologies. 1, what is a bull market or what is a bull run? A bull run or a bull market means that share prices are rising for a long period of time. Just simply think of bulls charging upwards. Bulls. Okay, that's a bull market. Dogged. Now, number 2 is a bear market. What's a bear market? A bear market simply means downward trend in the market. A bear market is the opposite of a bull market. It means that prices are falling over a period of time. So, bull up, bear down. Number 3, correction. This is simply a short-term dip or decline of about 10% of a stock price after it has been rising for a while. This is more like a market taking a breather, calming down, okay? It has to catch its breath. It can't keep running for a sustained period. So just imagine yourself running. At a point, you need to take a breath, cool down. That's simply a correction. A pullback or dip is somewhat similar to a correction, and this is when price drop briefly after an overall upward trend. Now, a pullback or a dip is not a crash. No, it's more like a temporary pause. And then we have a rally. Rally means that there is a sudden rise in market price. And this sometimes happens after a fall. There is an additional movement, which is just a sideways movement. It means that the stock price, it's not going up, it's not coming down, it's not crashing, it's not dipping, it's not pulling back. It's simply just trading sideways. Along the line, we're going to see things like support, resistance, reversal. We'll come to those terminologies later. The second section are simple, basic trading terms. What is a share? It's simply a slice of a company ownership. A slice, equity. Sort of, you have a share of a company ownership. A stock exchange is simply where buyers and traders meet to buy and sell. Okay, trading is simply buying and selling. Someone is buying your shares from you, or someone is selling their shares to you. Their shares, their share of ownership in that particular company. Brings me to the third trading terminology, and this is ticker symbol. What is a ticker symbol? It is simply a short code for each stock. Okay, for instance, Apple is AAPL. AAPL, that's the ticker symbol. Tesla is TSLA. That's the ticker symbol for Tesla. For instance, another stock like D-Wave is QBTS. Applied Digital is APLD. So sometimes in the trading landscape, we just use those ticker symbols to communicate which stocks we are talking about. What is an IPO? IPO simply means initial public offerings. And this happens when a company sells their shares to the public for the first time. Probably before then, it was just private ownership, okay? Private equity. But IPO, initial public offering, is when a company goes public for the first time to sell slices of ownership of their company to the public, like you and me. Market capitalization, aka market cap. What does this mean? This is a cool way of saying what the company is worth on the stock market. Off the top of my head, I think Nvidia has reached 5 trillion now. I'm not sure. That's like the highest. Nvidia's market cap is some countries or some continents' GDP. That's crazy. That's amazing. Okay? Market capitalization, aka market cap. Now, the simple formula for determining a company's market cap is the outstanding shares multiplied by the stock price or the share price. So, shares outstanding times stock price. The next terminology, you might hear things like liquidity. What's liquidity? Liquidity simply means how easy it is to buy or sell a particular stock without affecting the stock price. Simple. Volatility is a measure of how the price fluctuates or easily jumps up and down over a period of time. Volatility. Up, down, how easy it is to fluctuate or jump up and down. That's volatility. So lots of movement equal to high volatility. Now, another terminology which trips me up sometimes is spread. Now, spread is simply the difference between what the buyer wants to pay, in brackets, this is called bid, and what the seller wants to sell, in brackets, ask. This is called the spread, okay? Difference between the bid, what the buyer wants to buy, and the ask price, which is what the seller wants to sell. That difference between those two prices is the spread. So whenever you see a small spread, it can mean lots of activity on that stock, because what the buyer wants to buy and what the seller wants to sell, it's almost converging at the same point. So the spread is tight, means lots of activity. That stock is a hot cake. However, when you see a big spread, it means that the buyer's bid and the seller's ask are quite far apart, and that could indicate also low activity, okay? Spread. Section 3, technical indicators. We have things like moving average. This could be the average price over a specific period of time, maybe 50-day moving average, 200 days. So yeah, that's moving average. And this can help to smooth the price so you can see a trend. We also have simple moving average, SMA, exponential moving average. There is relative strength index, also known as RSI. And RSI is a way of measuring if a stock is overbought or oversold. A stock with an RSI of over 70 is overbought. And if the RSI is under 30, then it is in oversold territory. So some people might use the RSI as an indicator or a cue as to when they are going to sell and when they are going to buy. We also have what we call MACD, moving average convergence divergence, MACD. MACD shows momentum, whether buyer and seller strength is increasing. Volume is the number of shares traded. I think volume is one of my best indicators. I love volume. Volume tells a lot of stories. In fact, to be fair, I think I use volume almost daily. I just love volume. Even though volume will not tell you exactly how much is being bought or sold, but overall, when I look at that volume table, I get a feel of what I want to do. So volume is a very good one. Sometimes it's simple to tell a story at a glance. I love volume. I love volume. So high volume means strong interest, and low volume can mean weak interest in that stock. Okay, that stock might have a high volume this week and the next week it has a low volume. So for me, volume is quite like, before I decide to dabble in, it must be like top 15 volume table, period. Like, because the strong interest means that it's likely going to give it momentum, upward trend, rally, you know, boo. So volume for me is a key indicator. Volume and then the percentage change. Another technical indicator is the support level. And the support level is simply where a stock price stops falling. It hits there, and a lot of people have placed a buy order at that level. So when the stock gets there, it stops falling because there is now a buying interest. So that's what we call support level. When it stops falling, it bounces there and people are buying. Remember, the share price just increases when people are buying, when there's an interest for buying, and share prices drop when people are selling. So when it gets to the support level, it kind of like bounces off back there. Now, same thing, resistance. So we have support and we have resistance. Resistance is there is a buying interest, people are buying, and it gets there and people have set their orders to sell there. So when it gets there, it bounces back. So you have support here, which is where when it's falling, it touches here. And then when the rallies, it gets to your resistance. And because people have usually set their orders there, it gets there and it bounces there. Sometimes psychologically, resistance, for instance, can be like maybe the price gets to 80 and it is there, everyone is setting to sell there. Sometimes people are smarter, they set their resistance maybe to 79.5 and then they start. So resistance, support. Now, the cool part is another one known as breakout. This is when the price gets to that resistance. It keeps hitting there. Oh, it gets tired. It hits there, it bounces back, and then boom, a sudden volume or rally pushes it past the resistance. So when it goes past that resistance, that's the breakout. That's where it breaks out from. That's when we say there is a breakout, okay? It has passed the resistance. Same thing with support. Sometimes you say, oh, this stock has broken support. It means that there is not a lot of buying interest there. So when it breaks support, that's not good news. It's going to find another support somewhere down there, okay? So support, resistances are very key indicators if you are trading, or even if you want to buy long term, you want to know when to enter, okay? If it breaks support, it's good, but if it breaks resistance, then that's a breakout. Now, trend. Trend simply means what is the general direction of the price? Is it upward? Is it downward? Or is it sideways, like I said? So it could be an uptrend, downtrend, or it's just going sideways, okay? That's trend. Now, some fundamental terms. You will hear things like EPS simply means earnings per share. And this is the company's profit divided by the total number of shares. Price to earning ratio is another common terminology, PE ratio. So a high PE would usually mean high expectations, and a low PE would mean lower expectations. In my head, for me, I usually look at, depending on the sector, for some sectors like cybersecurity, you would see some stocks with PEs of 300. That's crazy. I think, if I'm not mistaken, Palantir, as of today, the PE is over 400, 500. That's crazy. Whereas bank stocks hardly exceed a PE, price to earning ratio, of 15, 20. And then you see, so I think Nvidia is around 40, 50 PE. So in my head, I just like to go for stocks that are like around 50, 60, 70, 10 to 70, I'm okay. Once you start entering price to earnings of 120, 200, I'm like, oof, I'm out of here. And you can also see negative PEs, especially for stocks or companies that have not started declaring profits. Okay, they're still owing some loans, they're not yet breaking even. So those companies can sometimes they can have a negative PE if they have a lot of debt. Dividend is simply when a company shares part of its profits with you. They give you a dividend, some proceeds from their profits. Dividend yield is simply your dividend as a percentage of the share price. Maybe you would have heard this a lot. Index, for instance, S&P 500, FTSE 100, NASDAQ 100. Okay. An index means a collection of top companies grouped together to show how that particular sector or market is performing, okay? S&P 500 is a group of the top 500 largest companies in the US based on their market cap, all right? So once every quarter, companies drop out of the S&P 500 and some companies are replaced. There are certain criteria to be met before any company can be included in the S&P 500, including their market cap, their revenue, their losses, their profits. So there are lots of their EBITDA earnings. There are lots of criteria to be met before those companies can be included. And then even those that are included have to keep meeting those criteria for them to sustain their position in the S&P 500 index. Now, what is an ETF? An exchange traded fund. An ETF is simply a basket of stocks that you can buy just in one pick. You don't need to go and start picking companies in tech, in retail, in real estate, in finance, in fintech. You just buy one ETF and it's like a basket, a pot of different stocks, diversified and balanced out for risks. Examples, you have the S&P 500 ETF, you have the FTSE 100 ETF, you have emerging world ETF, you have semiconductor ETFs, you have quantum ETF, you have crypto ETFs or digital technology or digital currency ETFs. There's different ETFs that you can buy. ETFs are usually classed as passive investing. Some of them pay out dividends, while others can accumulate the dividends within the ETF, leading to better compounding. Now, I don't know if you've heard of this, but there are some that are called blue chip stocks, and these are usually well-established, stable companies like Coca-Cola, Microsoft, etc. These are blue chip stocks. Section 5. Risk and investor types. Okay. 1. Risk tolerance. This simply means how comfortable are you with all these ups and downs? How comfortable are you? Are you high risk? Are you low risk? Are you moderate risk? What's your risk tolerance? What's your risk appetite? Diversification, like I mentioned in the previous video, spreading money across different sectors or different geography just to cushion against those risks and bumps. Also, even spreading money across different asset classes, stocks, real estate, bonds, just diversifying not just by stocks, but by asset classes, bonds, cash, and also by country to prove or to future-proof your portfolio against risks and economic downturns. Portfolio, if you've heard that word several times, it simply means all your investments together, okay? Your stocks and shares, your cryptocurrency, your real estate portfolio, your bonds, all of them together summarizes or defines your portfolio. Asset allocation, how you divide your portfolio across different asset classes. Stocks, bonds, real estate, cash, etc., gold, precious metals. How are you dividing your portfolio? Luxury item collection, arts and crafts. How is your portfolio diversified? Okay. A day trader is someone who buys and sells within the same day. There are people who are also called swing traders, and swing traders can hold those stocks for days or weeks. Ideally, they are there to catch trends, okay? Buy low, sell high, swing trading. They don't have to buy and sell in one day, but they can be buying with and selling within weeks, days, months, just to catch trends. And then we have long-term investing. And these people simply hold those assets or those stocks for years based on the fundamentals. As long as the fundamentals of the companies remain okay, they keep holding. Let's recap. We have day traders, we have swing traders, and we have long-term investors. Section 6, final round of quick fire terms. Number 1, year over year, in brackets, YOY. It simply compares this year over last year on year. Comparison, last year, this year, last year. Number 2, ROI, return on investment, ROI. It's measuring how much profit you have made when you compare it to your capital. Capital gains, this is your profit when you sell an investment. Order types, when you are trying to execute an order, we have the market order, and this buys at the best current market price. We also have limit orders, and limit orders only buy when your chosen price is reached. Stop loss, this automatically sells to stop or limit your losses. Another one is HODL. HODL, and it's a term used by long-term investors or long-term holders, meaning that they are holding for long-term. HODL. Now, that's the stock market dictionary simplified to you. Beyond understanding these stock market terminologies, if you want to build your understanding of money, behavior, and markets, here are some great books to start with. The Psychology of Money, Atomic Habits, The Richest Man in Babylon, Liar's Poker, 0 to 1, The Chimp Paradox, especially to help you regulate those emotions. These books will give you the mindset and practical foundation to grow as an investor or a trader. Your mind moves before your pocket or your body catches up, right? Please don't joke with books. There's usually no get-rich-quick scheme. Most times you have to make mistakes, you fail forward, but the most important thing is that you are learning, and that is why this platform is anchored on learning. If you want beginner-friendly breakdowns on money, mindset, and growth, hit the like button, subscribe, and share this with someone who is taking their investment journey seriously. All right, let me know what you think in the comment section. See you in my next video. Bye.